Hello guys, and welcome back to part 2 of Berkshire Hathaway Letter to Shareholders 1989. And without further ado, let's just jump right into our insurance operations. Shown below as an updated version of our usual table presented key figures for property casualty insurance industry. So, we have read through all of them in the past, so we're just going to do the past year and the current year, because the past year kind of updates sometimes, and the estimate is for this year. So the yearly change in premiums written 88 4.4, 89 2.1, stationary combined ratio after policyholder dividends 105.4 for 88, 110.4 for 89. Yearly change in incurred losses 5.5 for 88, 8.7 for 89. Inflation rates measured by GNP deflator 3.3 for 88, 4.2 for 89. And remember, for the stationary combined ratio, over 100 typically is bad. They say it's not too bad. He always says it's like kind of even out if it's like below 110, like 105, 108. But they went up to 110 again, so we'll see what he has to say about that. The combined ratio represents total insurance costs, losses incurred plus expenses, compared to a revenue from premiums. A ratio below 100 indicates an underwriting profit, and one above 100 indicates a loss. When the investment income that an insurer earns from holding policyholders' funds, quote-unquote the float, is taken into account, a combined ratio in the 107 to 111 range typically produces an overall break-even result, exclusive of our earnings on the funds provided by shareholders. For the reasons laid out in previous reports, we expect the industry's incurred losses to grow by about 10% annually, even in years when general inflation runs considerably low. Actually, over the last 25 years, incurred losses have grown at a still faster rate, 11%. If premium growth, meanwhile, materially lags that 10% rate, underwriting losses will mount, though the industry tendency to under-reserve when businesses turns bad may obscure their size for a time. Last year, we said the climb in the combined ratio was, quote, almost certain to continue and probably will accelerate for at least 2 more years, end quote. This year, we will not predict acceleration, but otherwise must repeat last year's forecast. Premium growth is running far below the 10% required annually. Remember also that a 10% rate would only stabilize the combined ratio, not bring it down. An increase in the combined ratio in 1989 was a little more than we had expected because catastrophes led by Hurricane Hugo were usually severe. Catastrophes led by Hurricane Hugo were unusually severe. These abnormalities probably accounted for about 2 points of the increase. If 1990 is more of a quote-unquote normal year, the combined ratio should rise only minimally from a catastrophe-swollen base of 1989. In 1991, though, the ratio is apt to climb by a greater degree. Commentators frequently discuss the quote-unquote underwriting cycle and speculate about its next turn. If that term is used to connote rhythmic qualities, it is, in our view, a misnomer that leads to faulty thinking about the industry's fundamental economics. The term was appropriate some decades ago when the industry and regulators cooperated to conduct this business in cartel fashion. At the time, the combined ratio fluctuated rhythmically for 2 reasons, both related to lags. First, data from the past were analyzed and then used to set new, quote-unquote, corrected rates, which were subsequently put into effect by virtually all insurers. Second, the fact that almost all policies were then used for a 1 to 3 year term, which meant that it took a considerable time for mispriced policies to expire, delayed the impact of new rates on revenues. These 2 lagged responses made combined ratios behave much like alternating current. Meanwhile, The absence of significant price competition guaranteed that industrial profits averaged out over the cycle would be satisfactory. The cartel period is long gone. Now the industry has hundreds of participants selling a commodity-like product at independently established prices. Such a configuration, whether the product being sold is steel or insurance policies, is certain to cause subnormal profitability in all circumstances but one: a shortage of unusable capacity. Just how often these periods occur and how long they last determines the average profitability of the industry in question. In most industries, capacity is described in physical terms. In the insurance world, however, capacity is customarily described in financial terms. That is, it's considered appropriate for a company to write no more than X dollars of business if it has Y dollars of net worth. In practice, however, constraints of this sort have proven ineffective. Regulators, insurance brokers, and customers are all slow to discipline companies that strain their resources. They also acquiesce when companies grossly overstate their true capital. Hence, a company can write a great deal of business with very little capital if it is so inclined. At bottom, therefore, the amount of industry capacity at any particular moment primarily depends on the mental state of the insurance managers. All this understood, it is not very difficult to prognosticate the industry's profits. Good profits will be realized only when there is a shortage of capacity. Shortages will occur only when insurers are frightened. That happens rarely, and most assuredly is not happening now. Some analysts have argued that the more onerous taxes recently imposed on the insurance industry and 1980s catastrophes, Hurricane Hugo and the California earthquake, will cause prices to strengthen significantly. We disagree. These adversities have not destroyed the earnings of insurances to write business at present prices. Therefore, premium volume won't grow by 10% in 1990, which means the negative underwriting trend will not reverse. The industry will, meantime, say it needs higher prices to achieve profitability matching that of the average American business. Of course, it does. So does the steel business. But needs and desires have nothing to do with long-term profitability of industries. Instead, economic fundamentals determine the outcome. Insurance profitability will improve only when virtually all insurers are turning away business despite higher prices, and we are a long way from that point. Berkshire's premium volume may drop to 150 million or so in 1990 from a high of 1 billion in 1989. Partially because of our traditional business continues to shrink, and partially because the contract under which we receive 7% of the businesses of Fireman's Fund expired last August. Whatever the size of the drop, it will not disturb us. We have no interest in writing insurance that carries a mathematical expectations of loss. We experience enough disappointment doing transactions we believe to carry an expectation of profit. However, our appetite for appropriately priced businesses is ample, as one tale from 1989 will tell. It concerns quote-unquote cat covers, which are reinsurance contracts that primary insurance companies and also reinsurers themselves buy to protect themselves against a single catastrophe, such as a tornado or hurricane, that produces losses from a large number of policies. In this contract, the primary issuer might retain the loss from a single event up to the maximum of, say, 10 billion, buying various layers of reinsurance above that level. When losses exceed the retained amount, the reinsurer typically pays 95% of the exceeds up to its contractual limit, with the primary insurer paying the remainder. By requiring the primary insurer to keep 5% of each lawyer, the reinsurer leaves him with a financial stake of in each loss settlement and guards against his throwing away the reinsurer's money. CAT covers are usually 1-year policies that also provide for one automatic reinstatement, which requires a primary insurer whose coverage has been exhausted by a catastrophe to buy a second cover for the balance of the year in question by paying another premium. This provision protects the primary company from being bare for even a brief period after a first catastrophe event. The duration of an event is usually limited to a contract to any span of 72 hours designed by a primary company. Under this definition, a widespread storm causing damage for 3 days will be classified as a single event if it arises from a single climatic cause. If the storm lasts 4 days, however, the primary company will file a claim carving out the 72 consecutive hours during which it suffered the greatest damage. Losses that occurred outside that period will be treated as arising from a separate event. In 1989, 2 unusual things happened. First, Hurricane Hugo generated $4 billion or more of insurance loss at a pace, however, that caused the vast damage of the Carolinas to occur slightly more than 72 hours after the equal severe damage in the Caribbean. Second, the California earthquake hit within weeks, causing insurance damage that was difficult to estimate, even well after the event. Slammed by these 2 or possibly 3 major catastrophes, some primary insurers and also many reinsurers that had themselves bought CAT protection either used up their automatic second cover or became uncertain as to whether they had done so. At this point, sellers of CAT policies had lost a huge amount of money, perhaps twice because the reinstatement and not taken in much in premiums. Depending upon many variables, a CAT premium might generally have run 3% to 15% of the amount of protection purchased. For some years, we've thought premiums of that kind inadequate and have stayed away from the business. But because the 1989 disaster left many insurers either actually or possibly bare, and also left most CAT writers licking their wounds, there was an immediate shortage after the earthquake of much-needed catastrophe coverage. Prices instantly became attractive, particularly for the reinsurance that CAT writers themselves buy. Just as instantly, Berkshire's Hathaway offered to write up to $250 million of catastrophe coverage, advertising that proposition in trade publications. Though we did not write all the businesses we sought, we did in a busy 10 days book a substantial amount. Our willingness to put such a huge sum up the line for a loss that could occur tomorrow sets us apart from any reinsurers in the world. There are, of course, companies that sometimes write $250 million or even far more of catastrophe coverage, but they do so only when they can, in turn, reinsure a large percentage of the business with other companies. When they can't, quote-unquote, lay off in size, they disappear from the market. Berkshire's policy, conversely, is to retain the business we write rather than lay it off. When rates carry on an expectation of profit, we want to assume as much risk as is prudent, and in our case, that's a lot. We will accept more reinsurance risk for our own account than any other company because of 2 factors. 1, by the standards of regulatory accounting, we have a net worth in our insurance company of about $6 billion, the second highest amount in the United States. And 2, we simply don't care what earnings we report quarterly or even annually, just as long as the decisions leading to those earnings or losses were reached intelligently. Obviously, if we write $250 million of catastrophe coverage and retain it all ourselves, there is some probability that we will lose the full $250 million in a single quarter. That probability is low, but it is not zero. If we had a loss of that magnitude, our after-tax cost would be about $165 million, though that is far more than Berkshire normally earns in a quarter. The damage would be a blow only to our pride, not to our well-being. The posture is one few insurance management will assume. Typically, they are willing to write scads of business on terms that almost guarantee them mediocre returns on equity, but they do not want to expose themselves to an embracing single quarter loss, even if the managerial strategy that causes the loss promises over time to produce superior results. I can understand the thinking. What is best for their owners is not necessarily the best for the managers. Fortunately, Charlie and I have both total job security and financial interests that are identical with those of our shareholders. We are willing to look foolish as long as we don't feel we have acted foolishly. Our method of operation, incidentally, makes us a stabilizing force in the industry. We had huge capacity when capacity is short, and we became less competitive only when capacity is abundant. Of course, we don't follow this policy in the interest of stabilization. We follow it because we believe it to be the most sensible and profitable course of action. Nevertheless, our behavior studies the market. In this case, Adam Smith's invincible hand works as advertised. Currently, we hold an exceptional amount of float compared to premium volume. This circumstance should produce quite a favorable insurance result for us during the next few years, as it did in 1989. Our underwriting losses should be tolerable, and our investment income from policyholders' funds large. This pleasant situation, however, will gradually deteriorate as our float runs off. At some point, however, there will be an opportunity for us to write large amounts of profitable business. Mike Goldberg and his management team of Rod Eldridge, Dinos Iridona, Ijit Jan, Phil Urban, and Don Worster continue to position us well for this eventually. Ooh, I need a sippy sip. Marketable securities. In selecting marketable securities for our insurance companies, we generally choose among 5 major categories. 1. Long-term common stock investments. 2. Medium-term fixed income securities. 3. Long-term fixed income securities. 4. Short-term cash equivalents. And 5. Short-term arbitrage commitments. We have no particular bias when it comes to choosing from these categories. We just continuously search among them for the highest after-tax returns as measured in the, quote, mathematical expectations, end quote. Limiting ourselves always to investment alternatives we think we understand. Our criteria have nothing to do with maximizing immediately reportable earnings. Our goal, rather, is to maximize eventual net worth. Below lists our common stock holdings having a value of over $100 million. A small portion of these investments belong to subsidiaries of which Berkshire owns less than 100%. And then, like normal, they have the shares, they have the companies, they have the cost, and they have the market. They don't have the total of them on this today, so we're just going to let it be as that. Just know that there's Capital Cities, Coca-Cola, Federal Home Loan Mortgage Corp. Oh, so we already... Oh, normally they have the totals for these. Interesting. But it does look like outside of that, the cost for all of them is much lower than the market value at the moment. Okay, moving on. This list of companies is the same as last year and is in only one case has the number of shares changed. Our holdings of Coca-Cola increased from 14,172,500 shares at the end of 1988 to 23,350 shares. This Coca-Cola investment provides yet another example the incredible speed with which your chairman responds to investment opportunities, no matter how obscure or well designed they may be. I believe I had my first Coca-Cola in either 1935 or 1936. Of a certainty, it was in 1936 that I started buying Cokes at the rate of 6 for 25 cents from Buffett and Son, the family grocery store, to sell around the neighborhood for 5 cents each. In this excursion into high-margin retailing, I duly observed the extraordinary consumer attractiveness and commercial possibilities of the product. I continue to note these qualities for the next 52 years as Coke blanketed the world. During this period, however, I carefully avoided buying even a single share, instead allocating major portions of my net worth to street railway companies, windmill manufacturers, anthratic producers, textile businesses, trading stamp issuers, and the like. If you think I'm making this up, I can supply the names. Only at the summer of 1988 did my brain finally establish contact with my eyes. What I then perceived was both clear and fascinating. After drafting somewhat in the 1970s, Coca-Cola had in 1981 become a new company with the move of Robert Goezzetta to CEO. Roberto, along with Don Keogh, once my across-the-street neighbor in Omaha, first rethought and focused the company's policies and then energetically carried them out. What was already the world's most ubiquitous product gained new momentum, with sales overseas virtually exploding. Through a truly rare blend of marketing and financial skills, Roberto has maximized both the growth of this product and the rewards that this growth brings to shareholders. Normally, the CEO of a consumer produces company, drawing on his natural inclinations or experiences, will cause either marketing or finances to dominate the business at the expense of others' discipline. With Roberto, the mesh of marketing and finance is perfect, and the result is a shareholder's dream. Of course, we should have started buying Coke much earlier, soon after Roberto and Don began running things. In fact, if I had been thinking straight, I would have persuaded my grandfather to sell the grocery store back in 1936 and put all of the proceeds into Coca-Cola stock. I have learned my lesson. My response time to the next glaringly attractive idea will be slashed to well under 50 years. As I mentioned earlier, the year-end price of our major investees were much higher relative to their intrinsic values than therefore. While those prices may not yet cause nosebleeds, they are clearly vulnerable to general market decline. A drop in their prices would not disturb us at all. It might in fact work to our eventual benefit, but it would cause at least a 1-year reduction in Berkshire's net worth. We think such a reduction is almost certain in at least one of the next 3 years. Indeed, it would take only about a 10% year-to-year decline in the aggregate value of our portfolio investment to send Berkshire's net worth down. We continue to be blessed with extraordinary managers at our portfolio company. They are high-grade, talented, and shareholder-orientated. The exceptional result we have achieved while investing with them accurately reflect their exceptional personal qualities. We told you last year that we expect to do little in arbitrage during 1989, and that's the way it turned out. Arbitrage positions are a substitute for short-term cash equivalents. During part of the year, we held relatively low levels of cash, and the rest of the year we had a fairly good-sized cash position, and even so choose not to engage in arbitrage. The main reason was corporate transactions that made no economic sense to us. Arbitraging such deals comes too close to playing the greater fool game. As Wall Street Ryan DeVoe says, quote, "Fools rush in where angels fear to tread." Fool to trade. I was going to say tread, but it's trade, end quote. We will engage in arbitrage from time to time, sometimes on a larger scale, but only when we like the odds. Leaving aside the 3 convertible preferreds discussed in the next section, we substantially reduced our holdings in both medium and long-term fixed income securities. In the long term, just about our only holdings have been Washington Public Power Supply System, WPPSS, bonds carrying coupons ranging from low to high. During the year, we sold a number of the low coupon issues which we originally bought at very large discounts. Many of these issues had approximately doubled in price since the purchase of them, and in addition had paid us 15 to 70% annually tax-free. Our prices upon sales were only slightly cheaper than typically high-grade tax exempts than commanded. We have kept all of our high coupons WPPSS issues Some have been called for redemption in 1991 and 1992, and we expect the rest to be called in the early mid-1990s. We also sold many of our medium-term tax-exempt bonds during the year. When we bought these bonds, we said we would be happy to sell them, regardless of whether they were higher or lower than at our time of purchase, if something we liked better came along. Something did. And concurrently, we unloaded most of these issues at a modest gains. Overall, our 1989 profits from the sale of tax-exempt bonds was about $51 million pre-tax. The proceeds from our bond sales, along with our excess cash at the beginning of the year and that generated later through earnings, went into the purchase of these 3 convertible preferred stocks. In the first transaction, we took place in July. We purchased $600 million of the Gillette Co. preferred with an 8.83 and with an 8.3/4% divide. It's either 83 or 8.3. So am I missing something here? No, I don't know. It's like typed weird. I don't know. We'll go with 83 and 1/4% divided. A mandatory redemption in 10 years and the right to convert into common at 50% per share. We next purchased $358 million of US Air Group Inc. preferred stock with a mandatory redemption in 10 years, a divided of 9 and 1. Oh, it's 8 3/4 divided. Okay, it's just printed weird, so I couldn't read it properly. So yeah, a divided of 9 1/4%, and the right to convert into common at $60 per share. Finally, late in the year, we purchased $300 million of Champion International Corp preferred with mandatory redemption in 10 years at 9 1/4 divided, 1/4% divided, and the right to convert into common at 38% per share. Unlike standard convertible preferred stock, the issues we are either non-soluble or non-convertible for considerable periods of time, and there is consequently no way we can gain from short-term price blips in the common stock. I have gone on the board of Gillette, but I am not on the board of US Air or Champion. I thoroughly enjoyed the boards I am on, but can't handle anymore. Gillette's business is very much the kind we like. Charlie and I think we understand the company's economics and therefore believe we can make a reasonable, intelligent guess about its future. If you haven't tried Gillette's new sensor razor, go right out and get one. However, we have no ability to forecast the economics of the investment banking business, in which we have a position through our 1987 purchase of Salmon Convertible Preferred. The airline industry, or the paper industry, this does not mean that we predict a negative future for these industries. We are agnostic, not atheists. Our lack of strong conviction about these businesses, however, means we must structure our investment in them differently from what we do when we invest in a business appearing to have splendid economic characteristics. In one major respect, however, these purchases are not different. We only want to link up with some people whom we like, admire, and trust. John Gottfried at Salomon, Colm Mockery Jr. at Gillette, Ed Holiday at US Air, and Andy Singler at Champion meet this test in spades. They in turn have demonstrated some confidence in us, insisting in each case that our preferreds have unrestricted voting rights on a fully converted basis, an arrangement that is far from standard in corporate finance. In effect, they are trusting us to be an intelligent owners, thinking about tomorrow instead of today, just as we are trusting them to be intelligent managers, thinking about tomorrow as well as today. The preferred stock structure we have negotiated will provide a mediocre return for us if industry economics hinder the performance of our investees, but will produce reasonably attractive results for us if they can earn a return comparable to that of America's industry in general. We believe that Gillette, under Coleman's management, will far exceed that return and believe that John, Ed, and Andy will reach it unless industry conditions are harsh. Under almost any conditions, we expect these preferreds to return us our money plus dividends. If that is all we get, though, the result will be disappointing, because we will have given up flexibility and consequently will have missed some significant opportunities that are bound to present themselves during the decade. Under that scenario, we will have obtained only a preferred stock yield during a period when the typical preferred stock will have held no appeal for us whatsoever. The only way Berkshire can achieve satisfactory results from its 4 preferred issues is to have a common stock of the investee companies do well. Good management and at least tolerable industry conditions will be needed if that is to happen. But we believe Berkshire's investment will also help, and that the other shareholders of each investee will profit over the years ahead from our preferred stock purchases. The help will come from the fact that each company now has a major, stable, and interested shareholders who chairman and vice chairman have, through Berkshire investment, indirectly committed a very large amount of their own money to these undertakings. In dealing with our investees, Charlie and I will be supportive, analytical, and objective. We recognize that we are working with experienced CEOs who are very much in command of their own businesses, but who, nevertheless, at certain moments, appreciate the chance to test their thinking on someone without ties to their industry or to decisions of the past. As a group, these convertible preferreds will not produce the returns we can achieve when we find a business with wonderful economic prospects that is unappreciated by the market, nor will the returns be as attractive as those produced when we make our favorite form of capital development, the acquisitions of 80% or more of a fine business with a fine management. But both opportunities are rare, partially in a size benefit our present and anticipated resources. In summation, Charlie and I feel that our preferred stock investment should produce a return moderately above those achieved by most fixed income portfolios, and that we can play a minor but enjoyable and constructive role in the investees' companies. Zero coupon securities. In September, Berkshire issued $902.6 million principal amounts of zero coupon convertible subordinated debentures, which are now listed on the New York Stock Exchange. Salmon Brothers handled the underwriting in superb fashion, providing us helpful advice and a flawless execution. Most bonds, of course, require regular payments of interest, usually semi-annual. A zero coupon bond, conversely, requires no current interest payments. Instead, the investor receives his yield by purchasing the securities at a significant discount from maturity value. The effective interest rate is determined by the original issue price, the maturity value, and the amount of time between issuance and maturity. In our case, the bonds were issued at 44.314% of maturity values and are due in 15 years. For investors purchasing the bonds, that is the mathematical equivalent of a 5.5% current payment compounded semi-annually. Because we received only 44.31 cents on the dollar, our proceeds from the offerings were $400 million, less than $9.5 million on offering expenses. The bonds were issued in denominations of 10,000 each, and each bond is convertible into 4,515 shares of Berkshire's Hathaway. Because of a 10,000 bond cost, 4,431, This means that the conversion price was $9,815 per Berkshire share, a 15% premium to the market price then existing. Berkshire can call the bond at any time after September 28, 1992, at their accrued value, the original issue price plus 5.5% compounded semi-annually, and the two specified days, September 28th of 1994 and 1999, the bondholders can require Berkshire to buy the securities at their accrued value. For tax purposes, Berkshire is entitled to deduce the 5.5 interest accrual each year, even though we make no payments to the bondholders. Thus, the net effect to us resulting from the reduced taxes is positive cash flow. That is a very significant benefit. Some unknowable variables prevent us from calculating our exact effect rates of interest, but under all circumstances, it will be well below 5.5%. There is, meanwhile, a symmetry to the tax law. Any taxable holder of the bonds must pay tax each year of the 5.5% interest, even though he receives no cash. Neither our bonds nor those of certain other companies that issued similar bonds last year, notably Lowe's and Motorola, resemble the great bulk of zero coupon bonds that have been issued in recent years. Of these, Charlie and I have been, and will continue to be, outspoken critics. As I will later explain, such bonds have often been used in the most deceptive of ways and with deadly consequences to investors. But before we tackle that subjective, let's travel back to Eden, to a time when the apple had not yet been bitten. If you're my age, you bought your first zero coupon bond during World War II by purchasing the famous Series EUS savings bond, the most widely sold bond issue in history. After the war, these bonds were held by 1 out of 2 U.S. households. Nobody, of course, called them Series E or zero coupon bonds, a term in fact that I doubt had been invented, but that's precisely what the Series E was. These bonds came in denominations as small as $18.75. That amount purchased at $25 obligation of the United States government due in 10 years, terms that gave the buyer a compounded annual return of 2.9%. At the time, this was an attractive offer. The 2.9% rate was higher than the general available on government bonds, and the holder faced no market fluctuation risk, since he could at any time cash in his bond with only a minor reduction in interest. A second form of zero coupon U.S. Treasury issues also began and surfaced in the last decade. One problem with a normal bond is that even though it pays a given interest rate, say 10%, the holder cannot be assured that a compounded 10% return will be realized. For that rate to materialize, each semi-annual coupon must be reinvested in 10% as it is received. If the current interest rates are at, say, only 6 or 7%, when these coupons come due, the holder will be unable to compound his money over the lifetime of the bond at the advertised rate. For pension funds or other investors with long-term liabilities, quote-unquote, reinvestment risks of these types can be a serious problem. Savings bonds might have solved it, except that they are issued only to individuals and are unavailable in large denominations. What big buyers needed was huge quantities of quote-unquote savings bond equivalents. Enter some indigenous and, in this case, highly useful investment bankers, led, I'm happy to say, by Salomon Brothers. They created the instrument desired by stripping the semi-annual coupon from standard government issues. Each coupon, once detached, takes on the essential characteristics of a savings bond, since it represents a single sum due sometime in the future. For example, if you strip the 40 semi-annual coupon from U.S. government bond due in the year 2010, you will have 40 zero coupon bonds with maturities from 6 months to 20 years, each of which can then be bundled with another coupons of like maturity and marketed. If current interest rates, say, are 10% for all maturities, the 6-month issue will sell for 95.25% 24% of maturity value, and the 20-year issue will sell for 14.20%. The purchaser of any given maturity is thus guaranteed a compounded rate of 10% for his entire holding period. Stripping the government bond has occurred on a large scale in recent years, as long-term investors ranging from pension funds to individual IRA accounts recognize these high-grade, zero-coupon issues to be well-suited to their needs. But as happens in Wall Street all too often, what the wise do in the beginning, fools do in the end. In the last few years, zero-coupon bonds and their functional equivalent pay-in-kind bonus bonds, which distribute additional PIK bonds semi-annually as interest instead of paying cash, have been issued in enormous quantities by ever junkier credits. To these issuers, zero, or PIK bonds, offer one overwhelming advantage. It is impossible to default on a promise to pay nothing. Indeed, if LDC governments had issued no debt in the 1970s other than long-term zero-coupon obligations, they would now have a spotless record of debtors. This principle at work, that you need not default for a long time if you solemnly promise to pay nothing for a long time, has not been lost on promoters and investment bankers seeking to finance even shakier deals, but its acceptance by lenders took a while. When the leverage buyout craze began some years back, purchasers could borrow only a reasonable sound basis in which conservatively estimated free cash flow, that is, operating earnings plus depreciation and amortization less normalized capital expenditures, was adequate to cover both interest and modest reductions in debt. Later, as the adrenaline of deal makers surged, business began to be purchased at prices so high that all free cash flow necessarily had to be allocated to the payment of interest that left nothing for the paydown of debt. In effect, a Scarlett O'Hara, quote, "I'll think about it tomorrow," end quote, positioned in respect to principal payments, was taken by borrowers and accepted by a new breed of lender, the buyer of original issue junk bonds. Debt now became something to be refinanced rather than repaid. The change brings to mind a New Yorker cartoon in which the grateful borrower raises to shake the hand of the bank's lending officer and gushes, quote, "I don't know how I'll ever repay you," end quote. Soon borrowers found even the new lack standard intolerable binding to induce lenders to finance even sillier transactions. They introduced an abomination, EBDIT, earnings before depreciation, interest and taxes, as the test of a company's ability to pay interest. Using this sawed-off yardstick, the borrower ignored depreciation as the expense on the theory that it did not require a current cash outlay. Such an attitude, and clearly delusional at 95% of American businesses, capital expenditures that over time roughly approximate depreciations are a necessity and are every bit as real as expense as labor or utility costs. Even a high school dropout knows that to finance a car, he must have income that covers not only interest and operating expenses, but also realistically calculated depreciation. He would be laughing out of the bank if he started talking about EBDIT. Capital outlays at a business can be skipped, of course, in any given month, just as a human can skip a day or even a week of eating. But if the skipping becomes routine and is not made up, the body weakens and eventually dies. Furthermore, a start and stop feeding policy will over time produce a less healthy organism, human or corporate, than that produced by a steady diet. A businessman, Charlie, and I relish having competitors who are unable to fund capital expenditures. You might think that waving away a major expense such as depreciation in an attempt to make a terrible deal look like a good one hits the limits of Wall Street ingenuity. Oh my gosh. Ingenuity. If so, you haven't been paying attention during the past few years. Promoters need to find a way to justify even pricier acquisitions. Otherwise, they risk heaven forbid, losing deals to other promoters with more imagination. So, stepping through the looking glass, promoters and their investment bankers proclaimed that EBITDA should now be measured against cash interest only, which meant that interest accruing on zero coupon or PIK bonds could be ignored when the financial feasibility of a transaction was being assessed. This approach not only regulated depreciation expense to the let's ignore it corner, but gives similar treatment to what was usually a significant portion of interest expense. To their shame, many professional investment managers went along with this nonsense, though they usually were careful to do so only when clients' money, not their own. Calling these managers professionals is actually too kind. They should be designated promotees. Under these new standards, a business earning says 100 million pre-tax and having debt on which 90 million of interest must be paid currently might use a zero coupon or PIK issue to incur another 60 million of annual interest that would accrue and compound but not come due for some years. The rate on these issues would typically be very high, which means that the situation in 2 years might be 90 million cash interest plus 69 million accrued interest, and so on as the compounded proceeds. Such high rate reborrowing schemes, which a few years ago were appropriately confined to the waterfront, soon became models of modern finance at virtually all major investment bank houses. When they make these offers, investment bankers display their humorous side. They dispense income and balance sheets projections extending 5 or more years in the future for companies they barely had heard of a few months earlier. If you are shown such schedules, I suggest that you join in the fun. Ask the investment banker for the 1 year budget that his own firm prepared as the last few years began, and then compare these with what actually happened. Some time ago, Ken Galbraith, in his witty and insightful The Great Crash, coined a new economic term, the bezel, defined as the current amount of undiscovered embezzlement. This financial creature has a magical quality. The embezzler are rich by the amount of the embezzle, while the embezzlees do not yet feel poorer. Professor Galbraith pointed out that this sum should be added to the national wealth so that we might know the psychological national wealth. Logically, a society that wanted to feel enormously prosperous would both encourage its citizens to embezzle and try not to detect the crime. But this means wealth would balloon through not an urge of productive work had been done. The saturational nonsense of the bedazzle is dwarfed by the real-world nonsense of the zero-coupon bond. With zeros, one party to a contract can experience quote-unquote income without its opposing experiencing the pain of expenditure. In our illustration, a company capable of earning only $100 million annually and therefore capable of paying only that much of interest magically creates earnings for bondholders of $150 million. As long as major investors willing don their Peter Pan wings and repetitively say, "I believe," there is no limit to how much income can be created by the zero coupon bond. Wall Street welcomed this invention with the enthusiasm less enlightened folk might revere for the wheel or for the plow. Here, finally, was an instrument that would let the street make deals at prices no longer limited by actual earning power. The result, obviously, would be more transactions. Silly prices will always attract sellers, and, as Jesse Urim might have put it, transactions are the mother's milk of finances. Okay, I think we're going to pause there. And if you're finding this on YouTube, don't forget to like, share, and subscribe. Hit that bell icon so that way you know every single time when I post. And leave a comment down below. What are your feelings around these bonds? I feel like I've heard of them, but not like in this detail. So I'm definitely going to have to do some more research on if this is still going on or if this is like a thing of the past. But if you would like to support me a little bit more, check out my links below and you can donate or buy some merch, and that will help me pay some bills, take care of my kittens, and make all this a little bit more magical in the future. And until next time, guys, bye.